There is a specific date in history that every single American should know, but almost none do. It is June 9th, 1974. On that day, in a secret meeting in Jeddah, Saudi Arabia, a pact was signed that would define the global economy for the next half-century. It was the pact that gave the US dollar its superpower. It was the agreement that allowed the United States to print trillions of dollars without consequence, run massive deficits without bankruptcy, and live beyond its means for 50 years. That pact was simple. The United States would provide military protection and weapons to the Saudi kingdom. In exchange, the Saudis would price every single barrel of oil sold to the world exclusively in US dollars. This created the petrodollar. It meant that if Japan wanted oil, they needed dollars. If Germany wanted oil, they needed dollars. It created a permanent artificial demand for the American currency that forced the entire planet to hoard our debt. But yesterday, quietly, without a grand press conference from the White House and without a breaking news banner on CNN, that treaty expired. And for the first time in 50 years, it was not renewed. The petrodollar is officially dead. The Saudi kingdom has announced it is joining Project M-Bridge, a digital currency platform run by the Bank of International Settlements in China, to trade oil in yuan, rupees, and gold. The monopoly is over. The anchor that held the US dollar to the physical reality of the global economy has been cut. We are now drifting into uncharted waters. The exorbitant privilege of the dollar is turning into an exorbitant burden. While Wall Street ignores this geopolitical earthquake, obsessing over AI stocks and quarterly earnings, Warren Buffett is reacting with the speed of a man who knows the ship is taking on water. Look at his balance sheet. Look at his actions. He is effectively shorting the US dollar. He is holding a record $382 billion in short-term cash, not long-term bonds. He is buying massive stakes in Japanese trading houses that deal in commodities. He is doubling down on Occidental Petroleum, buying the oil in the ground. He knows that when the world stops needing dollars to buy oil, trillions of those dollars currently sitting in foreign central banks will have nowhere to go but home. And when they come home, they will unleash a wave of inflation that will make the 2022 crisis look like a minor inconvenience. We are entering the era of the Great Repatriation, the era where the dollar loses its crown. And if your wealth is stored entirely in US-denominated paper assets, you are standing on a melting iceberg in the middle of a burning ocean. To understand why this is not just foreign policy news, but a direct existential threat to your grocery bill and your retirement account, we have to deconstruct the hidden mechanism of the petrodollar. We need to explain, in plain English, why the dollar has value in the first place. Most people think the dollar has value because the US economy is strong. That is only half the story. The real story is liquidity and demand. Imagine the US dollar is a ticket to a massive amusement park. Let's call this park the global economy. For the last 50 years, the United States had an exclusive deal with the owner of the roller coaster, Saudi Arabia, OPEC. The deal was, anyone who wants to ride the roller coaster, buy oil, must use a US ticket. This rule changed everything. Even if you are French and you have euros, you cannot buy oil directly. You first have to go to the exchange window, sell your euros, and buy US tickets, dollars. Only then can you buy the oil. This created a massive, artificial, non-stop demand for US tickets. Every country on Earth, from China to Brazil to Kenya, needed to hold billions of dollars in their vaults, just in case they needed to buy energy to keep their lights on. Because they needed to hold these dollars, they invested them in US Treasury bonds, loaning money to the US government. This allowed the US government to print trillions of tickets, dollars, and export them to the world. We sent them pieces of paper. They sent us cars, TVs, electronics, and oil. It was the greatest economic magic trick in history. It allowed American citizens to consume more than they produced for 5 decades. It kept our interest rates artificially low because there was always a buyer for our debt. But now, the park owner has changed the rules. They said, you don't need a US ticket anymore. We will accept Chinese tickets, yuan. We will accept gold. We will accept digital tokens. Suddenly, the world doesn't need to hold dollars anymore. China doesn't need a vault full of them to buy oil. India doesn't need them. So what happens to all those trillions of tickets that are floating around overseas? They get dumped. Central banks around the world are currently selling US treasuries at the fastest pace in history. They are de-dollarizing. And when the world sells dollars, the value of the dollar crashes relative to real assets. But here's the scary part, the part that leads to the silent crash. Those dollars don't just vanish into thin air. They have to go somewhere. They come back to the United States. They come back to bid on our real estate, our food, our companies, our farmland. This is the mechanism of the crash. It is a flood of liquidity returning to the source. It turns the global reserve currency into a local inflation problem. It means that the dollars in your bank account are about to face competition from trillions of expat dollars coming home to roost. Buffett sees this mechanism. He knows that the petrodollar recycling system, where we pay for oil with dollars and they use those dollars to buy our debt, is broken. The Saudis aren't buying our debt anymore. They are buying gold. Buffett knows that the only protection against a currency that is losing its global utility is to own things that have universal utility. Assets that the world needs regardless of what colored paper is used to pay for them. We need to move this from the abstract world of global reserve currencies to the visceral reality of your Tuesday morning budget. I want you to feel what imported hyperinflation feels like. This is not the 8% inflation we saw in 2022. This is structural currency debasement. I want you to close your eyes. Imagine it is a Tuesday morning in mid-2026. The news cycle is dominated by the BRICS Plus summit in Shanghai, but you tuned it out. You thought it was just politics. You get in your car to drive to work. You look at the gas station sign. Last week, regular unleaded was $3.80. Today, the digital numbers are flashing. $8.99. You blink. You think the sign is broken. You pull up to the pump. It's real. You put your card in. It pre-authorizes $200. You fill up half a tank because that's all you can afford. It costs you $90. Why did gas triple? Did a refinery blow up? No. The price of oil didn't change in gold. It didn't change in yuan. It changed in dollars. The dollar collapsed 30% overnight against global commodities because Saudi Arabia announced a massive oil trade settled in digital yuan. Your currency is now being treated like the Turkish lira or the Argentine peso. You drive to the supermarket shaking your head. You need groceries. You grab a gallon of milk, a loaf of bread, a package of ground beef, and some coffee. You get to the checkout. The total is $65. The coffee alone is $18. Why? Because coffee is imported, and your dollars are now monopoly money to the Brazilian farmers. They don't want them, so you have to offer more of them to get the same beans. You walk down the electronics aisle. You need a new laptop for work. The model you looked at last month was $1,000. Today the sticker says $1,850. Why? Because the microchips come from Taiwan and the assembly is in China. They are pricing goods in real terms and your dollar has lost its purchasing power. You check your bank account on your phone. The number is the same. You still have $10,000 in savings. You haven't lost money in nominal terms. But that $10,000 now buys what $4,000 bought last year. You have been robbed without a gun. You have been impoverished by the loss of your currency's status. You go home and look at your utility bill. It has doubled. Natural gas is priced globally. The local power plant has to pay global prices. You realize that inflation isn't just about things getting more expensive. It's about your labor becoming worthless. You are working harder, but your paycheck buys less every single week. This is the simulation Buffett is preparing for. In a world where the currency is dying, the man with the cash, Buffett, uses it to buy the assets, OXY energy, that reprice instantly to the new inflation level. When gas goes to $9, Occidental Petroleum's profits triple. Buffett's wealth floats on top of the inflation. Your savings sink to the bottom. But then happened what no one expected. The Federal Reserve tried to save the dollar by raising rates, and they broke the US government. The media and the government economists will tell you the dollar is strong. They will point to the DXY index and say, look, the dollar is up against the euro. But they are tricking you. They are comparing one sinking ship to another sinking ship. We need to look at the real history. We need to look at 1971, the Nixon shock. To understand where we are going, you have to understand where we came from. From 1944 to 1971, under the Bretton Woods Agreement, the US dollar was as good as gold. Literally. Any foreign central bank could take $35 and exchange it for 1 ounce of physical gold from the US Treasury. This kept the government honest. They couldn't print too much. or they would run out of gold. But in the late 1960s, the US printed too much money to fund the Vietnam War and the Great Society welfare programs. Sound familiar? Wars and welfare. France and Britain noticed. They started sending ships to New York to collect their gold. The US gold reserves were draining. The bank run on America had started. On Sunday, August 15, 1971, President Richard Nixon interrupted the popular TV show Bonanza. He looked into the camera and announced that he was temporarily suspending the convertibility of the dollar into gold. He defaulted. He broke the promise. The dollar became a fiat currency backed by nothing but faith and credit. The result? The 1970s. Inflation exploded to 12%. Oil quadrupled. The stock market crashed 50% in real terms. But then, in 1974, the US made the genius move that saved the empire. The petrodollar deal. We replaced gold with oil. We told the Saudis, we will protect you militarily if you price oil in dollars. It worked. It created a new demand for the dollar. It saved the system for 50 years. We are now living in the reverse of 1974. The deal that saved the dollar has been canceled. We are going back to the pre-1974 chaos, but this time, we don't have the manufacturing base. We have $36 trillion in debt, and we have competitors, China, Russia, who have their own payment systems, SIPs and bridge. We are naked in the storm. Buffett lived through 1971. He remembers the panic. He remembers that stocks crashed in real terms. He remembers that commodities were the only lifeboat. He is positioning for the Nixon Shock 2.0. He knows that when the currency regime changes, the rules of wealth change instantly. The saver becomes the loser. The debtor becomes the winner, if the debt is fixed. The owner of productive assets becomes the king. But here is the plot twist. The real danger isn't just Saudi Arabia or China. The real danger is a mechanism called the euro-dollar market and the Triffin dilemma snapback. This is a concept that is rarely explained because it is complex, but I will translate it for you simply. Because the US exported dollars for 50 years, there are trillions of dollars sitting in bank accounts outside the United States, in London, in Singapore, in Cayman Islands. These are called euro dollars, dollars held offshore. The estimated size of this market is $13 trillion to $20 trillion. Here is the twist. These dollars are shadow money. They are not under the control of the Federal Reserve. As long as the world economy is growing and globalization is working, these dollars stay overseas facilitating trade. But when the world fractures, when sanctions fly, when war breaks out, when the petrodollar dies, these dollars get scared. They want to come home. If even 10% of that $13 trillion tries to return to the US assets market, it is a $1.3 trillion liquidity bomb. It is too much money chasing too few goods. It creates a melt-up in asset prices. Stocks go up in nominal terms. But a meltdown in living standards. Prices go up faster than wages. Furthermore, we face the Triffin dilemma. This economic paradox states that the country with the global reserve currency must run trade deficits to supply the world with money. But eventually, the debt gets so big that the world loses trust in the currency. To fix the debt, you have to stop printing. But if you stop printing, the world runs out of money and crashes. If you keep printing, the dollar collapses. The US is at the end game of the Triffin dilemma. We have printed too much. The world has lost trust. Saudi Arabia ending the petrodollar is the vote of no confidence. Buffett holds $382 billion in short-term T-bills. Why short-term? Why not 10-year bonds? Because he knows the US government is trapped. If foreigners sell US bonds, interest rates spike. The US government cannot afford 10% interest on $36 trillion. They would be bankrupt in 6 months. So, the Federal Reserve must print money to buy the bonds, yield curve control. This printing destroys the currency. Buffett is hiding in short-term bills to roll over his cash constantly, avoiding the long-term destruction of the 10-year bond. He is betting on the government sacrificing the dollar to save the bond market. So, how is the oracle positioned for the death of the dollar? He is building a portfolio that looks like a hard money fortress. He is constructing an ark to float over the flood of paper money. The anti-dollar play. Occidental Petroleum, OXY. We keep coming back to this because it is the cornerstone. If the dollar dies, what becomes the numeraire, the unit of account? Energy. Energy is the universal constant. A barrel of oil performs the same work in China as it does in New York. By owning 30% of OXY, Buffett effectively owns 30% of a massive underground bank of liquid gold. If the dollar collapses, oil doesn't just go up, it reprices. Oil goes to $150, $200, $300 a barrel. OXY's profits explode in dollar terms. Buffett's wealth is preserved in purchasing power terms. He is owning the thing that the dollar used to represent. The Japanese hedge, the Sogo Shosha. Buffett surprised everyone by buying massive stakes, 9% plus in the 5 biggest Japanese trading houses: Mitsubishi, Mitsui, Itochu, Marubeni, and Sumitomo. Why? Are they great tech companies? No, they are commodity giants. They deal in physical stuff: metals, food, energy, textiles, infrastructure. More importantly, they operate in a different currency regime, yen, and trade globally. They are a currency hedge. If the dollar tanks, these companies earn money in other currencies. They are also masters of the carry trade, borrowing cheap yen to buy high-yield resources. Buffett is piggybacking on this. He is diversifying his political risk away from the US dollar hegemony. Selling the banks, the fiat proxies. Buffett has exited almost all his major bank positions: US Bancorp, Bank of NY Mellon, shrinking Bank of America. Banks are leveraged bets on the fiat currency system. They hold loans, assets, that are denominated in dollars. If the dollar loses value, the loans lose real value. If interest rates spike to defend the dollar, the bank's bond portfolios crash, like Silicon Valley Bank. Buffett knows that in a sovereign debt crisis, the banking system is the victim. He is getting out of the blast zone. Why not gold miners? The nuance. People ask, if the dollar is dying, why doesn't Buffett buy gold mines? Buffett famously hates gold because it sits there and looks at you. It doesn't pay a dividend. However, his move into OXY and trading houses serves the exact same function as gold, but better for him. Oil wells produce cash flow. Trading houses pay dividends. He prefers productive hard assets over static hard assets. But for the average person who can't buy an oil company, the lesson is the same. Get real. Own things that cannot be printed. The warning is clear. The petrodollar is over. The global discount on American living standards is ending. The 50-year party of cheap imports is done. How do you survive the great repatriation of 2026? Action 1. Own the universal currencies, gold and silver. Buffett might not buy gold bars, but you should. You are not a billionaire who can buy whole companies. Gold is the only asset that is not someone else's liability. It is the historic hedge against currency collapse. Look at what the central banks are doing. The People's Bank of China is buying gold. Russia is buying gold. Poland is buying gold. They are dumping dollars and buying metal. Follow the central banks, not the politicians. Allocating 5 to 10% of your portfolio to physical gold, silver is your insurance policy against the dollar going to zero. Action 2. Foreign exposure. Get dollars out. Don't have 100% of your wealth in US stocks, S&P 500, and US dollars. This is home bias. It is dangerous when your home currency is under attack. Look at ETFs that invest in emerging markets, excluding China if you fear geopolitical risk, or commodity-producing nations, like Brazil, EWZ, Canada, EWC, Australia, EWA. If the US dollar falls, the currencies of commodity exporters usually rise. You need to diversify your currency risk. Action 3. The fixed debt strategy. If you have a 30-year fixed-rate mortgage at 3% or 4%, do not pay it off early. This is the one-time debt is your friend. In a high-inflation de-dollarization scenario, the value of your debt collapses. You are paying back the bank with dollars that are worth less and less every month. The bank is losing. You are winning. Let inflation eat your debt. Keep your cash for buying hard assets. Action 4. Stock up on imported goods. Now, this is practical household advice. If you need a new computer, a new car, new tools, or replacement parts for your business, buy them now. These things are global commodities. When the dollar weakens, Their price in dollars will soar. Front-run the inflation. Turn your paper money into useful, durable goods before the price reset. A new generator in your garage is a better store of value than $1,000 in the bank if the dollar drops 20%. Action 5. Bitcoin. The digital gold option. Optional but relevant. Just like gold, Bitcoin is a non-sovereign asset. It is a hedge against the debasement of the dollar. The recent adoption by BlackRock suggests it is becoming a lifeboat for institutional capital. A small allocation, 1.5%, is a rational hedge against the fiat system breaking, offering portability that gold lacks. The final verdict on the end of the petrodollar is a call to reality. The 50-year vacation is over. The United States will have to pay the real price for its consumption. The exorbitant privilege is gone. We are becoming a normal country with a normal currency, which means we will feel the pain of our debt. Warren Buffett has already placed his bets. He is betting on things that are real. He is betting on things that bleed, burn, and build. He is ignoring the paper promises of politicians. He is prepared for the reset. Are you? Do not wait until the gas station sign says $10 to realize the dollar has failed. Do not wait until your savings buy half a cart of groceries to realize the rules have changed. Position yourself now. Get real assets. Get gold. Get educated. Be like Buffett. See the mechanism. Understand the geopolitical shift, and ensure that when the dollar loses its crown, you don't lose your kingdom. I am immensely grateful to you for staying until the end of this critical warning. This deep dive was designed to show you the tectonic shifts that the nightly news ignores because they are too scary to tell you. If you found this breakdown valuable, make sure to like and subscribe so we can keep bringing you the truth about the financial system that the brochures leave out. Stay vigilant, stay diversified, and we will see you in the next video.